Hey, welcome, Market Rebels. Happy Monday, everyone. I hope everybody had a fabulous weekend and another interesting day in the market, as always. But last week, we had our second candle break on Wednesday and Thursday of the 50-day moving average. So that was really big. This is on the S&P 500, the SPY. And then on Friday, we gave most of that second candle back. So we knew that today was an important one. Gapped up off the opening bell, immediately sold off, and then around 3:30, started to stage an impressive comeback. So I didn't see the actual close, but I believe that we just clipped into the positive territory, which is pretty impressive. But not to be unexpected, I guess. We do have the Fed meeting tomorrow with an announcement 2 p.m. Eastern time on Wednesday. So a lot of times the markets will trade sideways in these environments. We also show that the Fed futures are showing roughly about a 77% chance for a 75 basis point hike. And then the balance, let's say roughly 25% for a 100 basis point increase, a full percentage point. So we'll have to see what happens on Wednesday. So that's going to make things even more interesting this week and always adds to the volatility. And that's what we're here to talk about on Trading Tune-Up. So if you joined us last week, we were talking about vertical spreads and various aspects of about when to use them between the debit and credit. And this week, I wanted to talk about some other applications of vertical spreads for those of you who like to sell calls. And a lot of times traders don't ever expect to sell spreads, but they can be a wonderful tool. But as a prelude to that, we're going to just start by talking about a covered call and just selling calls in general. And then later on in the week, we'll look at selling spreads. So for today, let's take a fresh look at covered calls. And the reason I decided to do this is that it's a very popular strategy, and especially when we get into volatile environments. But there's a problem that most people are taught about how to approach a covered call. And I'm not saying it's wrong. I'm just saying that there are other ways to approach it, and that's what I wanted to share with you today. So what sets up the problem? Well, the thing that sets up the problem for most people is this idea of what's called a square root pricing rule. Sounds more complicated than it is, but the idea is that it takes about 4 times as much time to double an option's price. And here we go. This applies to at-the-money options only. And the reason for this is that option prices are proportional to volatility, and volatility is proportional to the square root of time. So that's where this odd pricing relationship comes from. So what exactly does it mean? Well, let's say that we have a 1-month option and we look on our broker's platform and it's trading for $1. And we look out to the 4-month option. What should we expect it to be trading for? Now, a lot of traders will say, oh, it should be trading for $4 because you have 4 times as much time. And that's absolutely not true. Here's the way that you figure it out. We can see that the difference in time here, the ratio is 4 times, and you take the square root of that number, which is 2. And it's this number right here that sets up the multiplier over on the right-hand side. So I know that this second option is going to be 2 times the price, roughly speaking, in the absence of skews in the markets. Let's say from a pricing model, it would show us that it's going to be twice as much. So we would see this option trading for $2, not $4. If this 1-month option were trading for 3, this one would be trading for twice as much, or 6. All right, so it's always going to be a 2-fold increase, not because there's twice as much time, but because there's 4 times as much time. So even that sometimes can be a new pricing relationship for traders. So let's try a different one. We have a 3-month option trading for 5. What's the 27-month option trading for? How do you figure it out? Well, we look at the ratio between these two. There's 9 times as much time on the second option. We take the square root of 9, that's 3. We come over to here, and this number is what tells us the multiplier. I know that this second option is going to be 3 times the price of the first. So it should be trading for about $15. So it's this pricing relationship that creates really interesting ways to approach strategies, and depending on whether you're using at the monies, in the monies, out of the monies, they are all strategic tools, and you have to understand them. So the square root rule, understand that in the financial markets, time is risk. The more time that you have on an option, the riskier it becomes. Now, it kind of goes backwards because a lot of times people say, oh, the short-term options are risky. Well, it's a different type of risk, especially for the out of the monies. There's a higher probability for them to expire out of the money. But in terms of the stock price being able to drift from its current price, which is really the definition of risk, the more time you have, the more risk that there is. And so because of this, longer dated options are cheaper per unit of time. There's more risk, market's going to discount those. So the shorter dated options are more expensive per unit of time. And again, it's this relationship that sets up, I don't want to say the misperceptions, but it sets up the way that most traders approach covered calls, which isn't always the best approach. So for example, let's go back to our 1 month option trading for $1, 4 month option trading for $2. Now, if you look at this, it looks like the 4 month option is more expensive. Traders will say, well, 2 is twice as big as 1. But take a look at this. If you buy the 1 month option, you're paying $1 for 1 month's worth of time, $1 per month. If you buy the 4 month option, you're paying $2, but for 4 months worth of time, you're actually paying 50 cents per month. It's actually cheaper per unit of time. So again, to be clear, yes, it is more expensive to buy the option. 2 is bigger than 1. But when you divide it out by the number of days, it becomes a lot cheaper. So an analogy that I often make is think of it like buying things in bulk, maybe going to Costco. If you buy a single can of, let's say, of a soft drink, it might cost you $1. But a 6-pack down here might cost you $3. And it's absolutely wrong to say, well, 3 is bigger than 1, so this is more expensive. Most people know not to make this mistake when they're shopping, but they fall right into it when they're doing covered calls. Okay, so if we look at this, yes, 3 is bigger than 1, but if we look at it per can or per ounce or some other standardized measure, you're paying $1 per can versus 50 cents per can. All right, so this is the thing that we want to look at as options traders. What are we receiving per unit of time? So again, this is where traders start to say, oh, I've got it for the covered call. We always want to maximize our profits. So we should therefore sell shorter dated options because again, they are relatively more expensive. Yes, that's true, but is that really what you're trying to do? So they will say, for instance, let's sell 4 weekly options instead of 1 monthly. And why did they make that decision? Because I'm getting more money per unit of time. I'm maximizing my profits. And this is how a lot of classes are taught, and people think that is the only way to approach the strategy. But we're going to take a different look at it. And the question we want to ask, is maximizing profits always the goal? It really never is. If it were, you'd be buying these shares on margin or borrowing money to buy lottery tickets. It's not always about squeezing out every last dollar that could possibly be obtained. So the thing that we always want to start with is a goal. And interestingly, you can't even define risk unless you tell me what your goal is. To one trader, this might be a risky trade. To another, it might be a safe trade. We need to know what the goal is first. So if we start with a goal saying, I'm trying to get X percent per week, month, quarter, whatever time frame you're looking at, now we can make decisions. So let's say that these are our shares of stock trading for 100. Now also remember, for the covered call, very important, it doesn't matter what you paid for the shares. Your risk for this position is the current market price. So I don't care if you paid $80 for the shares. If they're currently trading for 100, that is our risk. Because we could choose to sell the shares right now, and the fact that we're deciding to put them in the face of risk means that that's really what we're putting on the board at risk, $100. Now let's say that we sell a short-dated option for a weekly or something, especially if it's out of the money. So here we're selling the 105 call, that's where the bend occurs. And you can see we don't really have a big downside hedge. See, we've only received maybe 50 cents or $1, something very small. Now, the better way to see this is what you're doing with a covered call is you are giving up some of these uncertain potential cash flows. You're sealing off the upside, but you're also saying, I'm not real sure I was going to receive those. And we're taking some cash today, let the call buyer speculate on this area in green. So sometimes you can think of this as the bird in the hand strategy. I'd rather take the cash up front, even though it might be a fraction of what I could earn, but at least I know I've got it. But the main reason for doing a covered call is not for income generation. Sometimes you'll hear that. It's not necessarily wrong, but it's not really a fully correct view because you are giving up income. The real reason for doing the covered call is this downside hedge. And look at this. When you sell the short-term options, especially out of the money, you don't have a really big downside hedge. And so there you have to say, is it really worth it to have this small downside hedge and completely seal off your upside? So what's the risk in this position? Well, the risk is that you might only get one chance. That's the fallacy when people say, oh, you always sell the weekly options. And I want to sell this 105 call every single week for the next year and a half. All right, well, what if you sell it for 1 week, you collect $1 or 50 cents, and now the stock's trading at 80. Good luck trying to sell the 105 call. And if you sell the 80 call or the 85 and it ramps up on you, now you've just locked yourself into a loss. So just because you might have the intention of selling this weekly over and over and over doesn't mean you're going to be able to do it. Why? Because you didn't set up a really big hedge to begin with. So let's take a look at an example. Here's Microsoft. Back when I shot it, it was trading for 243. And let's look at the 250 strike. So we're going to sell something slightly out of the money. Now, these only have 3 days till expiration. And right here, the mark is $1.74. So if we collect $1.74 divided by the current market price of the stock, not what you paid for it, that's 0.72%. Now, granted, it is for only 3 days, but you're also subjecting yourself to a potential 10% capital gain. And this is another problem with selling the out of the monies. The bulk of this strategy is getting its rewards from the stock price moving, which if the stock went to 250, it was going to be worth 250 whether you sold the call or not. So in this case, the additional benefit was just this $1.74. Didn't really do a whole lot for you, especially for the downside. But now let's take a look if we went out, let's say 220 days. Now, do you have to go out this far? No, I'm just doing it to really emphasize a point, but pick some other expiration date. Give yourself something that's going to give you a bigger downside hedge. But watch this. That's trading for 23 and change, and 23.32 divided by 243, current stock price, is 9.5%. Annualized, that's about 16%. So if you're trying to earn 16% per year, or at least over the next 220 days, that's your ticket. We know for a fact we can get it. Could I have done better if I had sold the weeklies over and over and over? Yes, assuming I could have done that. But see, we don't know. So one of the things you always want to do is remove the uncertainty. This leads you right to your goal. Now, my return if exercised, that means if I get assigned, it's actually going to be almost 23%. But look at the size of the downside hedge. So here's the covered call, and here's the stock. So this is selling the 3-day option. It gave us a 1.1% downside hedge, yet completely sealed off the upside. But when I sell that one for 220 days, look at this. We go out here, we have a 9.5% downside hedge. Look at these gains. Okay, we've got an additional $21.58 for a downside hedge. And in markets like these, that's a nice safety net to have underneath you, considering that it also met your goal. Now, if it didn't, whether it's not enough or too much, pick a different expiration date. But I just wanted to share with you a different way of looking at a covered call. Focus on your goal and find an option, longer dated perhaps, that gives you a better downside hedge and still allows you to meet your goals. So always remember that every decision involves risk. And when you understand how to make the unknowns a known, that's when you're going to start making better decisions, and that always leads to better results. So for anyone who'd like to learn more, there we go. We're offering free coaching, a free coaching session with one of our world-class coaches, 30-minute one-on-one. Pick a topic. They can just give you so much information and so many insights for strategies that are relevant to you. So if you learn something from these trading tune-ups, you're going to learn even more when it's custom fit for your needs. So if you're interested, give them a call. It's 815-957-9125. Free coaching, 30-minute one-on-one consultation. And I hope you take advantage of it because, again, you're the only one that benefits from your investing. So we do this every Monday, Thursday, Friday. On Thursday, we're going to start looking at selling spreads as part of covered calls and also as a hedge for straddles, things that people would never think to do. How do they work? Join us Thursday and Friday to find out, and we'll see you then.